Hello everyone, and welcome to Virginia International University's MBA 605 auditing course. Today we want to start talking about the audit responsibilities and objectives, and this is chapter 6 of our text. And so we'll cover topics that include objectives of conducting the audit of financial statements and the audit of internal controls, which we discussed slightly in Chapter 5, and the fact that the SEC requires essentially two different audits that can be conducted in an integrated form or fashion, but one of the financial controls around the internal controls around financial reporting, and then the financial statements themselves. We want to distinguish management's responsibility for the financial statements and internal controls from the auditor's responsibility for verifying the financial statements and effectiveness of internal controls. We also want to talk about classifying transactions and account balances into financial statement cycles and identify the benefits of this cycle approach to segmenting the audit. And then lastly, we're going to distinguish between the different categories of management assertions about the financial information that's presented in the financial statements. And so, as we know, the purpose of the audit is to provide financial statement users with an opinion by the auditor on whether the financial statements are presented fairly in all material respects in accordance with financial accounting framework. That financial accounting framework is generally accepted accounting principles, or GAAP. And these users then, these financial statement users, then will make economic decisions based on analysis and information presented in the financial statements. And it's because this information, or these economic decisions based on this information, inherent to that decision are certain assumptions around the information as a result of the audit opinion that subjects us as auditors to the legal liabilities we discussed in Chapter 5. And so these are the steps to developing our audit objectives. We want to understand the objectives and the responsibilities of the audit. We divide the financial statements into cycles. That is, are they sales cycles? Are they liability cycles? Are they footnote disclosure cycles? So what are the different cycles that are associated with financial statements? And this is largely dependent on the type of organization that we're auditing. So for instance, a manufacturing firm would have inventory cycles. A professional services firm likely wouldn't have inventory cycles in the same terms as the manufacturing organizations. We want to understand the management assertions about the financial statements that are inherent to each of these cycles. Then we want to know the general audit objectives for each of these classes of transactions, accounts, and disclosures, and know the specific audit objectives for those same items. So we want to know general audit objectives and specific audit objectives for these classes of transactions or account balances or disclosures. It is management's responsibility to issue financial statements. It is management's responsibility to assure users of those financial statements that there are internal controls that are designed and operating as intended to ensure the integrity of those financial statements. Let's be clear, that it is management's responsibility for these two items. It is then the auditor's responsibility to come in and audit to standards and assess, issue an opinion as to whether or not management's assertions are accurate or adequate. Sarbanes-Oxley increases management's responsibility for the financial statements, and you may recall this is largely due to the violations that we were evidenced to with fraud cases like MCI, WorldCom, Enron, which caused Sarbanes-Oxley in 2002 to be implemented as statute, and it requires that the CEO and CFO must certify these quarterly and annual financial statements submitted to the SEC. And this is just an example of the management report surrounding internal controls. And you can see where in the second paragraph, management, who is the president and CEO signing the letter, and the CFO signing the letter, maintains an effective internal control structure. It consists in part of organizational arrangements with clearly defined lines of responsibility and delegation of authority and comprehensive systems and control procedures. So again, this is a letter signed by the management company that is sent to the auditors as recognition of their responsibility for these areas. And then we also know that Sarbanes-Oxley provides for criminal penalties for anyone who knowingly falsely certifies the statements. And so here we see what the objectives of the auditor are. The objectives of the audit is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatements. The objectives of the auditors are to express an opinion whether the financial statements are prepared in all material respects in accordance with an applicable financial reporting framework, generally or usually generally accepted accounting principles. And it is the objective of the audit to issue a report on the financial statements and communicate as required by audit standards in accordance with the auditor's findings. So here again we see we want to obtain reasonable assurance so that we can issue an opinion that is then reflected in a report that goes along with the financial statements to its users. So here we again see the types of considerations that fall within the umbrella of our responsibility. So we're responsible to identify material misstatements, whether through error or fraud. We should conduct the audit with a sufficient level of professional skepticism. We're providing reasonable assurance, and we talked about before reasonable assurance versus absolute assurance. And keep in mind we cannot provide absolute assurance because of this idea of cost-benefit trade-off and how much it would cost so much more to provide absolute assurance that it would offset any benefit associated with that versus reasonable assurance. And then we have this idea of errors versus fraud, and as accountants we're constantly assessing the situation to determine where we see misstatements, was it an error or was it fraud, and then what are the actions that we're responsible for executing once we reach that decision. And so as we discussed, when we're performing an audit on financial statements, we segment those audits into smaller components so that we're able to wrap our hands around those and conduct audits of these smaller components. And these smaller components we generally refer to as business cycles. And then inherent to each of these business cycles are certain management assertions. And so we have assertions about classes of transactions and events for a period under audit. We have assertions about account balances at period end, that is, what is the accounts receivable balance, what is the accounts payable balance. And then we have assertions about presentation of the financial statements and the disclosure notes to the financial statements. And all of these, again, keep in mind, are management assertions that we're auditing to confirm. They're not the auditor's assertions. And so we talk about the occurrence assertion. That concerns whether the recorded transactions included in the financial statements actually occurred during the period. The completeness assertion addresses whether all transactions that should be included in the financial statements are in fact included. The accuracy assertion addresses whether transactions have been recorded at correct amounts. The classification assertion addresses whether transactions are recorded in the appropriate account. And then the cutoff assertions address whether transactions are recorded in the proper accounting period. And so we see that we have these different management assertions that we're testing through in transactions and events. And we have other assertions, some of which are the same, some of which are different, that we are testing to confirm account balances. So when we talk about existence, we're talking about an account balance. Does an accounts receivable does the right to an accounts receivable really exist? When we're talking, this is an account balance, is our center column, and we're talking about the existence. So does the Balance really exists. Does the client really owe us the accounts receivable balance? And that's the existence assertion. Have we presented it with respect to the valuation and allocation assertion? Have we presented it the right balance? That is, do we expect to fully collect the amount presented? And do we have, under the rights and obligations for an accounts receivable, do we have the right? That is, it hasn't been encumbered by some other agreement with a bank or some other institution that we don't own the accounts receivable. We don't have the right to receive the payment later. And then we have the same with respect to presentation and disclosure. So you can see that a lot of the assertions across the different categories, transactions and events, account balances, or presentation and disclosure, are the same with a few differences, and then we're testing each of those in accordance with our audit testing procedures. And so in order to opine or come to some conclusion, we have to evaluate the results of the evidence we've collected and the comparison of how that evidence was accounted for and presented according to standards. And so in order to get to that point, we must obtain sufficient and appropriate audit evidence to support these management assertions in the financial statements we just talked about. And that process has 4 specific phases. And so phase 1 includes obtaining an understanding of the entity and its environment, an understanding of internal control, and assessing control risk, and assessing the risk of material misstatement. Phase 2 requires then, once we've assessed those risks, of determining the level of evidence we're going to gather based on the assessment of risk that we just talked about, and then performing test of the controls around those transactions and test of those transactions. After we've performed phase 2, we go into phase 3, which says we perform analytical procedures and test the details of balances. And so we talked before that analytical procedures are these tests of financial and non-financial relationships between data to make sure that it makes sense. So do the balances as presented, when we look at these relationships, do they make sense, or we inquire further of management as to why they don't. And once we've performed phase 1, 2, and 3, we then have to evaluate the outcome of all of that in order to come to an opinion, then complete the audit, and then issue the audit report. And so this finishes up the chapter on the audit responsibilities and objectives. But I hope that you're able to see that our responsibility is to issue an opinion on financial statements. And inherent in that responsibility are these objectives. We get to fulfilling that responsibility and satisfying these objectives through these 4 phases of the process here. And so I encourage you to go back and read Chapter 6 and make sure you're comfortable and familiar with it. As usual, I remind you that these discussions are not intended to substitute for the readings. Please don't hesitate to email the facilitator any questions or concerns you have about the reading or this presentation. And thank you for your attention. Bye-bye.